Good morning, everybody. I hope that you all had a good weekend and you're all looking forward to the week ahead. If we have a look at what happened in the markets last week, we saw mostly negative territory. That was caused particularly by a bad Friday, where we saw a lot of the markets fall quite considerably. Again, I guess it's just a lot of uncertainty going on in the world at the moment, Brexit being one of the factors, earnings, etc. But the stats for the week weren't a disaster. The Dow was actually up on the week, albeit it's only 0.3%. As I spoke about in my previous briefings, you don't see a huge amount of movement in that index. The Nasdaq was down 1%, and we saw the Nikkei was down 3%. Shanghai was flat, albeit that was only on a 3-day trading week last week, and we saw the DAX was also down 2.7%. Again, as I mentioned, a lot of those falls coming on the Friday. The bundle of four slightly outdid the Nasdaq. You'd have lost 0.8% on your money there. But as I'll move on to again later, the longer term view on that is still very, very bullish. On the currency side of things, we see the US dollar strengthen against the sterling and against euro. I'm guessing that Brexit's a major factor as to why that's happening. Clearly, there could be a drop in the value of the British pound if they do decide to leave. Again, like I mentioned before, I don't think that'll be sustainable, but at the same time, people want to protect themselves against that particular possibility. So therefore, we saw the dollar against sterling down at 141. We saw it fall 2%. We also saw the euro fall 1%. And again, I think that's probably driven by the uncertainty in what's going to happen there and what's going to happen to the strength of the euro. So people are putting their monies into US dollars. On the Japanese yen and the Australian dollar, we saw the week finish pretty flat. The Aussie dollar's at 135 and the Nikkei, the Japanese yen at 106. So on the sporting fields this weekend, we had obviously the start of the Euros. I have to admit I'm very impressed with the quality of football. Of course, that's countered by the lack of quality in some of the behaviour of some of the fans outside, whether it's the English's fault or the Russians' fault or the police fault. It is not, something we want to focus on. It's just, bad behaviour and perhaps a little more thought should have been put in by the security. On the rugby front, we had two of the Northern Hemisphere teams win when many expected it to be a Southern Hemisphere whitewash. So congratulations on England on a fantastic performance against Australia, and in particular a fantastic performance by the Irish to beat the South Africans. So rather than sort of chuck a quote at you and talk about a sort of scaremongering pension story like I often do, I'm just going to go through a couple of things that one of the fund managers that I deal with talked about, a guy called Nick Train. Now, I know that at the end of the day, we're all paid to be bullish and we're all paid to be positive, but he came up with 3 reasons as to why you should still be investing your money in equities. And one is the cost of feeding a family has reduced. In 1955, it would have cost 33% of your salary to feed a family. Today, that's down to 15%. As technology and man's ability to be more innovative in the way that it produces food, and also the fact that we have low commodity prices, that's going to continue. And as Mr. Train put it, it gives people more money to spend on Magnum ice creams, which are a Unilever product. There's also a belief out there, which comes from Warren Buffett, that the CEOs of these great companies still have some profit margins in them. They're not. US companies are not at their largest, their highest profit margins. There's still a way to go. There's still great brains running these companies, and corporate America can improve. And therefore, although price to earnings seems quite high in many of the large blue chips at the moment, if those earnings can increase and we get some balance there, there's still room for growth. And of course, the deflationary environment, although it's causes troubles in certain areas, ultimately it does mean that people have money in their pocket to spend on stocks and shares. This is shown, the proof in the pudding, if you like, by a couple of fund managers that I follow out there. Whilst we all know the markets hasn't been the easiest place in the world to be this year, look at three of the funds that I follow: Fundsmith, Terry Smith. You'd see that's up 9.4% on the year to date. And if you look at the last 3 months in two areas, I'm a big fan of the Polar fund managers, and they've got a great healthcare fund and they've got a great technology fund. In the last 3 months, had you put your money into both of those, you'd have made a 10% return. So, these returns are out there, and these are the type of funds you need to be in, not just in your savings, but also in your pensions, because whilst a lot of the pension managers do a good job, they spread the risk almost too much. You're in funds of funds of funds of funds of funds, and when you have that, obviously, it impedes on your overall return. Take control of that situation. Get yourself involved in some of these guys like Smith, like Mahoney at Polar, and take advantage of returns. 8, 9, 10, 12, 15, even 20%. I saw one of the tech funds was up this year. So there it is for you. Anything you need, please get in touch. Enjoy your week. Bye.